former Federal Reserve Chairman, President of Greenspan Associates, also author of the recent book, The Map in the Territory. Mr. Chairman, happy birthday.
Thank you very much. I appreciate that.
You're very welcome. And we've already talked about someone's going to sing you happy birthday, Mr. Chairman, and you need to choose between either Sorkin to sing that to you, or I would prefer Becky. Do you have a preference there?
Becky's got a little more sonorousness than either of you gentlemen.
I agree.
Thank you, Mr. Chairman.
Let's get right to a couple of things that I think that is interesting and points that you've made recently, Mr. Chairman. And one is that we're under the impression that we're very productive here and that the country has been thriving because of our productivity. But you think one of the reasons that we've been growing below plan in terms of GDP is that productivity isn't where it should be?
Absolutely. If you look at the data, we have zero productivity growth in the last couple of years. Productivity growth, almost exactly percentage point to percentage point, shows up in the GDP figures, slightly adjusted for the non-business sector. But the point of issue here is we are not showing an increase in output per hour, and that has ramifications through the average wage issue, employment. In fact, if you don't get productivity right in an economy, your economy is in trouble.
And it's hard for lay people to understand exactly what you're talking about. We all think we're working I'm trying to be productive. We're working hard. We're working more hours. Productivity it could be held back by what factors in your view? Not just whether we're coming to work early and leaving late.
Well, it's got basically to ask the question and answer it, of course. How much do we produce in the hours that we expend? And that obviously affects the wage rate because one of the iron laws that we observed for a long time is that the real wage of the economy, and that includes compensation per hour for all levels, including profitability, but the real wage must move with real output per hour. And it's double entry bookkeeping in a sense. And it is, and that's what the problem is. We're probably 1 to 2 percentage points lower in GDP growth than we should be.
Does this have to do with not making I know we've talked in the past that we haven't made long-term capital investments. Businesses haven't been doing that. We also, the savings rate hasn't been what it should be recently. And one of the things that you've attributed that to is the bipartisan, you haven't blamed it on either party, but the increase in entitlements, like, I don't know, Medicare C, and now we've got, all these entitlements in the last 6 years or so. If that holds down the saving rate, is that why we don't have productivity growth?
Well, that's what the data show. Remember what we're looking at. We're looking at an annual rate of increase in entitlements of close to 9% a year. And these are mandated, so it's not an issue of the market affecting them at all. But it's a sad occasion because most of the people, the vast proportion of them, who actually receive benefits believe that they're getting their money back with interest. And essentially, that's what originally, say, Social Security was when Franklin Roosevelt signed it into law in 1935. It was a defined benefit plan very closely related to the private sector. And everybody believed that it was their employer's money, their money, plus interest they were getting back. And in all of the entitlements in a related form, it's not the same, but Medicare is very closely is very close to this. And the two big ones clearly are Medicare and Social Security. What we have then is a very tough political problem. Every person who is involved in getting benefits, with rare exceptions, believes it is theirs by right. Mm-hmm. And try to take that away politically is the most difficult thing one can think of
Third rail.
for somebody running for office.
Alan, I want to raise the issue of energy and the price of oil. You know, one of the things we saw yesterday in the Challenger report in terms of layoffs was a huge number of layoffs in the energy sector, as you might expect. But, you know, the conventional wisdom is that the rest of the world is supposed to be a huge beneficiary of these low oil prices. And it hasn't really felt that way. At least you're not seeing that in the numbers yet. And some people say, if you look at just even some of the Fed numbers, that really all the growth we've had over the past couple of years is just in energy. And if you strip that out, it's nothing.
No, energy, the 50% decline in the price of crude oil has had a significant impact on personal consumption expenditures in the United States. If we, in fact, were not getting that, we would really be in very poor shape indeed. But the effect of the price decline is real. It is a one-shot effect. Remember, it doesn't continue the growth rate. It's a one-shot surge in the level of consumption, and then it flattens out. But the effect is real, and I think it will continue provided we don't reverse the price change very rapidly.
We've talked about how difficult it is for us to export with where the dollar is because of the weakness in Europe. So we're all pulling for Europe to maybe start doing a little bit better. So, you know, for a lot of different reasons. But in your view, the euro, the way that the common currency was set up is almost destined eventually for failure. Is that true? Or if they did get their fiscal houses more coordinated and banking more coordinated, could it still be salvaged, or do you still view that eventually it's just going to collapse?
I think not. I mean, actually, remember the euro did work for 9 years, 1999 through 2008. But the reason it did is that we were in a global boom. And remember, what the issue here is competitiveness between the various countries. In that 9-year period, almost anything you produced, you could sell. And as a result, even though unit costs of, for example, Greece, Portugal, and Spain were rising much faster than Germany, nonetheless, they were able to maintain very close spread against basically the unit costs, I shouldn't say the unit cost, but of the implicit exchange rate that they were dealing with. And what the problem is today is that you have a number of countries who ordinarily, given what they're dealing with, they would be devaluing. But they can't devalue, and they're locked in. Remember, the original purpose of setting up the euro was a step towards political consolidation of Europe, which most European intellectuals and analysts and policymakers all realized that we had just had 2 major world wars on the European continent. And only consolidation politically would essentially resolve that issue. And that was what they were trying to do, and indeed I think are still trying to do. And I don't believe, as I've stated before, that the euro can hold together unless we go to a political consolidation of Europe. The economic pressures pulling it apart are just too extraordinarily strong, and the continuing bailout of Greece suggests how strong they are.
You've made some comments, but not a lot on QE. I know you don't want to necessarily evaluate, you know, your successors, a lot of the moves. But let's talk about QE in Europe. It seems very difficult to orchestrate. Will it work over there? Do you think that we got a large benefit here, or does it really just gloss over our lack of long-term investment for what we need here?
Well, what QE did in the United States, both QE 1, 2, and 3, is basically by buying very significant quantities of the issuance of long-term U.S. Treasuries and mortgage-backed securities, we drove the real long-term interest rate down. doing that creates a price-earnings ratio expansion because of the arbitraging that goes on in the marketplace, so that the low real long-term interest rate showed up in a higher price-earnings ratio for income-producing properties, which are stocks, property of all types, and that's real. Obviously, if and when interest rates start to move, that's going to get reversed, but we're still in a position where we can't argue that we're extremely overvalued in the marketplace, even though I know you're talking about individual bubbles. Bubbles, I might say parenthetically, are essentially an aspect of human nature, will never be changed. And what we have to do is to recognize that we can absorb a bubble without economic consequences, as indeed at the end of the dot-com boom showed us. But if we get leveraged types of toxic assets, we have a very serious problem, as 2008 and 1929 showed us.
All right, Mr. Chairman, once again, I want to wish you